Good morning and welcome to Technically Speaking Tuesday. It is, of course, election day. It's midterm elections, and of course, this is the big thing that everybody's watching right now. Today's Technically Speaking post goes through a couple of different scenarios that we're looking at in relation to the markets where we are now. The markets did open up positive this morning on expectations that the GOP, that Republicans will retain control of both the House and the Senate. So right now the market likes that because, well, it suggests that we'll get ongoing more spending, more deficit spending, which we've had since the beginning of this year with the passage of the deficit budget bill. Also an increase and potentially more tax cuts for the households. And of course, that's all hoping to translate into a continued rate of economic growth. But there are some caveats to that outcome. And there's a few things that we'll talk about today. In particular, we go through this in our Technically Speaking analysis in the report that's attached to this video. But the thing importantly here is that what the outcome ultimately is really going to be more dependent upon what policies can actually get passed. So even if the outcome of the midterm elections today is that the Republicans and conservatives remain in both control of the House and the Senate, which is likely, but if they lose enough seats, it could actually make it possible that even with just a loss of some seats, since that there's no real policy that's passed with 100% of the conservative vote, that a loss of enough seats to Democratic control could stymie any future actual activity in terms of fiscal policy as it relates to the government in terms of tax cuts, additional spending, more deficit spending, etc. The other issue becomes really at some point, if we're going to continue to increase deficit spending next year, debt is already expected to rise by about another $1.5 trillion. We're currently running an almost $1 trillion deficit in an economic expansion. You normally don't run a $1 trillion deficit in an expansion. You run that during a recession. So the question becomes really, how much more gracious will the bond market be in terms of, well, basically buying the bonds and keeping interest rates low? So let's talk about the markets first. Then we're going to talk about the more important issue here, interest rates. But let's talk about the markets on a short-term basis here. Now, the markets are up a little bit this morning, but we're pushing up into very, very important resistance, which runs all the way back to January of this year, right around that 27.66 level on the market on a weekly basis is going to be problematic. That's also where the longer-term moving average runs into place. We used this rally here over the last couple of days to lift some positions out of the portfolio. And again, because of this change in the dynamic, moving averages have begun to slump over. We're running into this resistance. And most importantly, for the first time really since 2015, we are currently trading below the long-term trend line. So there's a real concern here, along with the weekly sell signal, that we have actually changed the tenor of the market in the short term. Now, this doesn't mean that we can't get some nice rallies here, which again, we're watching the market rally here a bit today. But the question is going to be sustainability of that rally once we get past this election. We're going to come back to start focusing on earnings, which have been okay, but earnings have not been great. Take a look at the forward outlook for a lot of these companies in terms of earnings because of tariffs and trade wars. That forward view has actually been worse than expected. Most importantly, a lot of the forward estimates on earnings have already come down. Estimates for 2019 have declined by almost $4 a share just in the last month. So again, the outlook for earnings and what's currently driving the markets is, of course, most concerning. And even despite the pullback in the market, valuations are still trading over 30 times earnings. So really, a lot of what's happening here, we're seeing a deterioration on the earnings front, and we're seeing the market begin to weaken, and that is more historically normal and more important of a market topping process. In fact, currently, if we go back and look at the market all the way back to 1995, there have been only two other times in history where we have had the market actually break the long-term bullish trend at a time when relative strength and a major sell signal were all in place at the same time. That only happened here. And back in 2015, 2016, we actually never registered a violation on a monthly basis of the long-term bullish trend. So that's why that time was different. But we have done it this time, and of course, we have a very similar pattern that's melting up here. So again, watch this very carefully. There's a real expectation here that we may have changed the dynamic. Now, why would that dynamic change, right? Economic growth is good. We've seen employment numbers lately that are good. So why all of a sudden have we begun to deteriorate here? And look, this all comes back down to the most important thing. which is interest rates. Interest rates drive the economy, and whenever interest rates have had a very sharp move higher, it does one thing importantly, and especially it does this in an environment where we are heavily leveraged, whether it's corporate debt, consumer debt, government debt, you name it, margin debt. All those are tied to interest rates, and this rise in interest rates has now come down to this long-term trend line. And the risk here right now is an environment where all of a sudden interest rates matter. People buy payments, they don't buy houses, they don't buy cars. We're already seeing a real impact to mortgage rates at 5%. We're seeing housing slow down, we're seeing auto sales slow down. But the issue is that in this election in particular, if the GOP retains control, the biggest risk here is that this will help foster through more Trump agenda, which on the surface you say, hey, that's great, right? More tax cuts, more spending. We're going to build a border wall. We're going to an infrastructure program. Well, that's all great, fine and dandy, except you've got to pay for it. And we're already issuing $1.5 trillion in debt next year. The question is going to be just how much can we withstand in terms of rising interest rates? And of course, the more debt issuance you have, that means that more people have to come to the market to actually buy that debt. But the Federal Reserve, they're stepping out of the bond buying game. China, stepping out of the bond buying game. The ECB, the Bank of Japan, they're all stepping out of the bond buying game. So in other words, the number of people available to buy those bonds, that pool is now being reduced. Now, just last week, we talked with Peter Bookvar about this very issue. This is one of the big issues for the markets going into next year. This is what he had to say.
Unfortunately, I feel like rates have the potential to go up much higher. And unfortunately, part of that is a drag from what's going to happen to the European bond market. Mm-hmm. I mean, I was of the belief in the fall of 2016 that the drop in yields after Brexit, when you reached $12 trillion of negative yielding securities, that was the end of the bond bull market. Mm-hmm. Now, how it progressed after that, I did not know. And the reason why I was feeling that is because what triggered the negative interest rates was, of course, the ECB predominantly. I'm not even going to include the Swiss and the Swedes and the Danes. And then Japan sort of got peer pressured into going the interest rate route. But I think soon after, when you saw what was happening to bank profitability and bank stocks, that the ECB and the BOJ were actually having second thoughts about going negative. Mm-hmm. So then you fast forward to where yields went in the summer of 2016, and I thought, well, if yields aren't going to go any deeper negative than where the ECB and the BOJ had them, then I saw there was a limit to how far yields can then drop. So the U.S. 10-year got to at 137, 138, and then obviously, over the last couple of years, you've seen this creep up. Obviously, the Trump presidency helped to quicken the pace of the interest rate move on the longer end of the curve. So now you have a situation where there's a multitude of reasons for the rise in U.S. interest rates. You have nominal GDP, which the last couple of quarters running north of 5%. You have inflation numbers that have obviously ticked up. You have tariffs that are creating its own inflationary issues. You have the budget deficits that you mentioned that are now mm-hmm. blowing out. And, it was fine to say that deficits don't matter when you're in a bond bull market. But if you are in a bond bear market, which I believe we are in, maybe deficits do start to matter. Maybe excess supply does start to matter. Then you throw in there's no buying of U.S. Treasuries from the Japanese and the Europeans because the cost of hedging out your dollar risk is completely offset any yield grab. Then you've had this dynamic this year where pension funds were encouraged to speed up the topping off of their pension funds by using U.S. Treasuries because after September 15th, the tax benefit of deducting that at a 35% rate was going to go to 21%, making it less attractive. So you had a lot of pull forward of U.S. Treasury buying this year. That, of course, has ended. So, and then I do think an important factor is when the ECB ends QE, is where do European bond yields go? We've obviously seen what happened to Italian yields, but where do German bond yields go? And I have to believe that if the German bond 10-year yield goes to north of 1%, it's unlikely the U.S. Treasury yield is still going to be about 3.15. Now, the spread between the two, which has gotten very wide, could compress, but I think rates could go up for not the right reasons, which would then cause its own problems on an over-indebted global economy and certainly a U.S. economy where leverage really manifested itself on the corporate balance sheet.
So the important point here, and this is the discussion that Peter Bookvar and I had in much more detail, and again, I suggest you go to our website, realinvestmentadvice.com. You can listen to the entire podcast on the website. It's on the front page this afternoon there for you. But the most important thing about that conversation is that interest rates matter, and they matter a lot. Sure, could interest rates move up here a little bit more? Absolutely, but he's absolutely right. It's only talking about fractions of an increase higher, because you cannot run a stronger economic environment at a time where we have rising interest rates. Rising interest rates do one thing, which is to slow economic growth, quell inflation, and ultimately there's never been a point in history where interest rates have gone up as much as they have now, and you have not experienced some sort of either economic issue, recession, or worse. Thanks for tuning in today, and make sure you get by our website, Real Investment Advice. You can watch the entire interview with Peter Bookvar, also our recent interview with Chris Martenson, talking about the economy and the markets, and of course, more about your money. And of course, send us your questions, comments, and emails, and subscribe to our YouTube channel, and watch the Lance Roberts Show podcast every day at YouTube, Lance Roberts Show. Thanks for joining, and we'll see you next week on the next edition of Technically Speaking Tuesday.